In next slide, I would like to talk about the business name, that is a ground up cafe. Here it is located in 42 Hill Street, Eleanor, Tasmania, Australia, with postcode 7150 and contact number is 0362842135.
So I will tell about the general details of the business. The business opens on the working days Monday to Saturday from 10 a.m. to 8 p.m. and the Sunday off. That is a general time that the business tends to work in this case so as to provide it the services to the customer, and there has been full of working staff available. Secondly, store has been servicing both in store delivery and online order booking to its valuable customer, and also the services of the online delivery so that the customer can order the product of the store through the app and delivery will be provided by the store as soon as possible in this case. The business is owned by the William Sander that is working in this case for more than 10 years and have relevant experience, and also he will provided all the working knowledge that will be needed for the customer to analyze the working of the store fluently. The business will be starting on 20th September 2022. That will be date on which the store will be starting the working in this case, so that there will be proper opening and that there will be proper working need of the customer to be fulfilled. In finance details, William Sender has used 1,50,000 for the improvements, design, working capital, and opening inventory. The breakout will be store design $1,00,000, working capital $25,000, opening inventory $25,000. In this case, the store will be needing the basic investment so that there will be providing the working of the basic structure that will be needed from the customer, and in order to make sure that the store will be opening in the store and the basic structure will be properly established in the order, and from the amount almost $1,00,000 will be consumed for the purpose of making the design of the store, like making the tables and the chair and the kitchen, for the making of the dishes, and also some such as like making the basic sitting arrangement and a system of music, and so that the customer can enjoy the coffee and have a good time. Amount $25,000 will be needed for the purpose of the working capital, like day-to-day working of the customer in this case. Similarly, the amount 25,000 will be needed for the purpose of the opening inventory for the cooking and serving the customer in this, and to provide the customer with the purpose of proper working of the finance and stock in this case.
Products and services. The product that will be provided in the store are the things like the following along with the price for the product that will be provided in this case to the customer in this case, like tea $3.40, coffee $3.60, cappuccino $3.90, hot chocolate $3.50, fruit juices $3.20, milkshakes $2.70, cheese sandwich $2.40, vegetable sandwich $2.50, so that there will be providing the working of the product to the customers in this case, and similarly like making the working so that each product can be made available to the customers in this case at the reasonable rate, and large amount of the customer can be attached in this case for the same, and there will be a paper working of the same in this case to the customer. General strategy: buying the raw material required for the coffee business from the wholesaler directly, that will reduce the cost price and sell the coffee at lower rate. Attract more customers. It's advisable to review your supplier agreement at different time of the year to determine if you can negotiate a better deal. Staying with the same supplier may no longer be profitable of your business.
In key cost prices, some of the key components, key prices that will be required to run the revenue for the business in this case and for paying off the business loan are in CVP and break-even analysis. The cost volume profit analysis, also commonly as break-even analysis, look to determine the break-even point for different sales volumes and cost structures, which can be useful for managers, which can be useful for making short-term business decisions. CVP analysis makes several assumptions, including that the sales price, fixed and variable costs per unit are constant. Running a CVP analysis involves using several equations for price, cost, and other variables which it then plots out on an economics graphs. The CVP formula can be calculated the break-even point. The break-even point is the number of units that need to be sold or the amount of sales revenue that has to be generated in order to cover the cost required to make the product. The, the reliability of CVP lies in the assumptions it makes, including that the sales price and the fixed and variable cost per unit are constant. The constants are fixed within a specified production level. All units produced are assumed to be sold, and all fixed costs must be stable. Another assumption is all change in expenses occurs because of changes in activity level. Semi-variable expenses must be split between expense classifications using the high-low method, scatter plot, or statistical regression. The contribution margin can be stated on a gross or per unit basis. It represents the incremental money generated for each product unit sold after deducting the variable portion of the firm's cost. Basically, it shows the portion of sales that helps to cover the company if fixed costs. Any remaining revenue left after covering fixed costs is the profit generated. So, for a business to be profitable, the contribution margin must exceed total fixed costs. In income statement, the analysis of the income statement involves comparing the different line items within a statement, as well as following trends lines of individual lines items over multiple periods. This analysis is used to understand the cost structure of a business and its ability to earn a profit. Horizontal analysis is a side-by-side comparison of income statements for multiple periods. A good comparison is for every month or quarter in a year. Items to look for in this analysis include the following. Essentially, seasonality. Sales may vary markedly by period and do so in a regular cycle that can be anticipated. This may result in predictable losses in some periods and outsized profit in other. Missing expenses. It can be quite obvious when an expense is not recorded in one period, since there is a sharp drop in one period and twice the usual expense in the next period. Tax rates. The tax rate used should be the expected one for the entire year. If the tax rate used is a low on early in the year and higher on later in the year, then the accounting staff is not using the full year rate anticipated rate, but rather the rate directly applicable to each reported. Once both of the preceding analyses have been completed, look at the following additional line items for more information. Depreciation. Some organizations only recorded depreciation expenses once a year for the full year. This means that many months have an excessive amount of profit, while the last month of the year is crushed by a large depreciation expense. Bonuses. The same issue rises of for bonuses as per depreciation. They may only be recorded at the end of the year, even though one could reasonably have anticipated the bonus outcome sooner and recorded them sooner. By raises, some organizations give everyone pay raises in the same month, so a bump in compensation expenses is predictable.
I am stating the statement of financial position. If you want a clear understanding of how your business is doing financially, a fairly thorough understanding of your financial statements is essential. This exercise also lays the groundwork for future business plans. A sound understanding of financial statements will help you to identify unfavorable trend and tendencies in your business operation. For example, the unhealthy buildup of inventory or accounts receivable. Before the situation becomes critical, monitor your cash flow requirements on a timely basis and identify financing needs early. Monitor important indicators of financial health. For example, liquidity ratios, efficiency ratios, profitability ratios, and solvency ratios. Monitor periodic increases and decreases in wealth, like specifically owners or stockholders' equity. Monitor your performance against your financial plan. If you have developed one sound understanding of financial statement will help you to identify unfavorable trend and tendencies in your business operations. For example, the unhealthy buildup of inventory or accounts receivable. Before the situation becomes critical, monitor your cash flow requirements on a timely basis and identify financing needs early. Monitor important indicators of financial health. The next, I am describing the cash budget. A budget is an estimation of the cash flows of a business over a specific period of time. This could be for a weekly, monthly, quarterly, or annual budget. This budget is usually to assess whether the entity has sufficient cash to continue operating over the given time frame. The cash budget provides a company insight into its cash needs and any surplus and helps to determine an efficiency allocation of cash. Companies use sales and production forecasts to create a cash budget along with the assumptions about necessary spending and accounts receivable collections. A cash budget is necessary to assess whether a company will have enough cash to continue operations. If a company does not have enough liquidity to operate, it must raise more capital by issuing stock or taking on more debt. In conclusion, from the following report of the cafe named as Ground Up Cafe, it has been concluded that the business will begin in 4 to 5 days, and to reach the break-even point of the business there is a requirement to generate $1,365 of revenue every day and need to sell at least 210 customers every day for the business to reach the break-even situation where there will be no profit and no situation. For this reason, the idea of the business will be kept as it can grow in the future and reach the profit margins even in this case. Some issues that has been faced in the starting of the business and related to the low customer interest, as there are many alternatives available in this case for the customer, and also that there has been a low start and for maintain the accounts it has been observed that there is no owner's capital in the business that needs to be fixed.